Good evening, traders and investors, and welcome to my series of learning basics of share market. Well, today we'll be looking at five different basic terms that will be using in our investing and trading journey. To start with, to start with, we'll be learning following terms, that is pre-open market, gap up opening, gap down opening, money, face value, and dividend. Okay, so to start with, let me share my screen where I have noted down few of the points that will help you to understand these terms in better way. Okay, I have opened my Word file. Let me check where it is. It's here. Basic terms of share market. Okay, so the first one is pre-open market. Pre-open market generally, uh, this is a session which happens between 9 a.m. to 9:15 a.m. Whatever orders that are placed after the market order, okay, after the market, for example, market timing is from 9 a.m. to 3:15 p.m. So whatever orders are placed after that, those orders get settled during 9 a.m. to 9:15 a.m. Okay, so here I have also written an example, like suppose if I had placed a buy order of 20 quantity of land share outside the trading hours, I'll be given shares during 9 a.m. to 9:15 a.m. only. Okay, so you can place your order even after the trading hours, but it will get executed only during the trading hours. Okay, so so this is how it is. Let us also visit. Mm, let us visit NSE website and look at have a detailed study on this pre-open markets thing. Okay, I hope my screen is visible in this moment. So to understand pre-market data, so we have visited NSE website. Here we'll go to market data and yeah, pre-open market. So as I said, that pre-open market happens between 9 a.m. to 9:15 a.m. So generally it all the trades or orders get executed till 9:07 till 9:10 a.m. Okay, so here we have pre-open order collection. Okay, so uh, you can come at 9:07 or 9:08 a.m. and uh, you can view this data and have an analysis about the market, uh, how it will be going uh, towards the day. Okay, so this is the chart of 7th October, that is on Friday. And during that time, the shares, there had been 13 shares which has advanced. That means the price of those shares have increased due to the purchasing, and there has been declines of 36 shares due to selling of shares which happened after the trading hours, and there has been one share which uh, which has got unchanged. Okay, so basically in pre-open market will be only getting data of only those stocks which are listed in Nifty 50. So when we as of now, let us stick to this basic in pre-open market. In future video series, we'll be also learning about how we can use this data for our trading and investing. Okay, so this is what is pre-open market. Next thing that we are going to see is gap of opening. Gap of opening is basically gap of opening is that is used. Uh, it is a term that is used to indicate the price has risen from a certain level and open. Okay, for example, if a share has closed at 135 rupees, but in the next day open it has opened at 137 rupees, so that means the share has gap of opening. Okay, so similarly it happens with Nifty 50. Nifty 50 is generally an index. Nifty 50 is an index, uh, index which represents the overall average of average of the shares ever that are listed in Nifty 50. There are total 50 of those shares that are listed out there. Okay, so we can also see this in trading view. Let's go to trading view and see. Uh, yeah, here. So here I have selected Reliance stock. I have hourly chart in this. Then here we have to just identify whether it has got gap of opening or not. Okay, so let us take this step. This is 4th of October, and if I move the cursor over here, it will be 6th. 5th was holiday. Okay, so this can be termed as gap of opening, because you see the Nifty has opened here and closed. It has formed a wick is that a candle, and it has given closing at 2415 the previous day. The next day it has opened much higher than the price that it was closed. So it was closed at 2413, but it had opened at 2428. Okay, so this is called gap of opening. I hope you are getting the point. uh, Next, similarly, we have gap down opening. In gap down opening, what happens is that the uh, at 9:50 when the market opens, the price of the share will be lower than the closing of the price that it already had the previous day. For example, here we can see the gap down opening. Okay, if I move my cursor over here, it is showing. mm, well, let me remove this. Okay, yeah. So if I move my cursor, this is the chart of closing chart of on 23rd September. Okay, it has closed in around 2438, but the next day, that is on 26th, 23rd, we had 2 days holiday. Okay, that is on 26th. Okay, it has opened, you know, it has opened around 2000 and it has opened around 2403. Okay, similarly, we can see here 27th and 20th September. It got closed at around 2392, and the next day it opened at 2371. Okay, so as the name suggests, gap down opening is something like if a share has closed at a particular price, say 300 rupees, the next day if it opens at 280 rupees or 270 rupees or 395 rupees, uh, you know 395 rupees lesser than the closing price of the previous day, then it is called gap down opening. And if the share of the price has increased than the previous day, okay, suppose the previous day closing was 200 and today it has opened with the share price of rupees 220 rupees. Okay, so then that is called as gap of opening. Okay, it goes similar with all these indexes as well. Indexes are like Nifty Metal, Nifty 50, Nifty Pharma, Nifty 80. Okay, so this is the concept of gap up and gap down opening. Okay, so far so good. Well, let's move to the next one. What is next? Volume. Well, volume. Let me take you to the definition of volume. Then I'll be able to make you understand it in better way. So here I have written it down. Volume refers to the number of shares traded during the day of a company. Okay, volume basically is during the trading hours, that is from 9:15 to 9:15 to 3:30 p.m. and the number of shares that has been traded at that particular interval. Suppose you are looking at it at 12 o'clock. Okay, so at that particular time interval, how much volume is there? How much volume is there means how many shares are bought and sold uh, at that particular time. That will be shown. Uh, that will be shown. Uh, That is what the volume refers to. Okay, so this is for volume. Uh, we can view volume through money control. Let's visit. You can have you can find all information about any stocks in this money control app. So let us see 50 week. Yeah, okay. This is the number of shares that had been traded on that previous trading day. Okay, so this is how we can view volume. You can also view through your broker's chart, broker's terminal. Yeah. So this is what is volume. Next we have face value. Let us see what is it defines. The price, the price at which shares of the company was bought by the promoters. The promoters are ones who starts the company. It's the promoters who decide the face value of the company, and it is generally between rupees 1 to rupees 10. Okay. The face value is written at the face of the document. The face value needs to be at least rupees 1 or in multiple of rupees 1. So this is what face value is, and declares uh, uh, whenever company declares any dividend, it is on its face value. So if you need to view the face value of a company, if you want to know what is the face value of that particular company, just head into this money control website, and let's see, I have and select the share that whose face value you want to see. Go to corporate action, and let me see if I'm able to find it or not. Wow, we have all data. Yeah, I hope we get here. Dividend yield, net thousand. See, this is share. Hmm, this is ONGC. So ONGC shares is there. Here the face value is 5. So rupees 5 is the face value. Okay. So what happens is that as the company grows old, the face value, you know, if they according to the decision of the promoters, there's means those who decide the face value of the company, they might split it split it based on their needs. Okay, what will be their needs, we'll discuss in further chapter. And so this is the face value. This is how you can see the face value of the company. And next, we'll be talking about dividend. Dividend is something that a company decides to give to its shareholders. Company's profit that is distributed to the company based on the number of shares owned by an individual. It is not mandatory, but it is not mandatory, and it is also the decision of board of directors to company whether to give dividend or not. Okay, so dividends are decided based on the face value of the company. And just now, as you saw, that the face value of ONGC was 5%. So if company decides to decide, it's not 5%, it's rupees 5. If company decides to give you 200 percent of dividend, then it will be generally, it won't be like if the share price is 145, you will get double of it. You will get 200% means you will get 10 rupees for each share. 100% means 5 rupees as we saw there, and 200% means 10 rupees. Okay, so this is how it is. What in all we learned today? We learned about uh, pre-open market, gap up opening, gap down opening, volume, face value, and dividend. Well, that's all for today. See you in next video. Thank you.